analysis is the study of the interrelationship between cost, volume, and profit. And all that analysis or that study does is to look at what happens to our profit when volume of output varies, given the costs and the selling price. So assume that the selling price is constant, the cost per unit is constant. What happens to our profit when volume of output changes? So the analysis can be done using graphical method and equation method. So we have gone through the graphical method. All that you need is to get the selling price given, then the variable cost or the marginal cost per unit given. Remember that the marginal cost is made up of the direct material cost, direct labor cost, and direct expenses. In some questions, you'll be given the variable cost per unit. In other questions, you will be given the cost per unit for this material. You have to put them together to get the variable cost. Once you get a variable cost and the fixed cost, that one is fixed, is in total fixed, given. And so once that is given, and then the volume of output or the volume of activity is given you, you can just do the analysis using the graphical method. All that you do is that get the total sales by multiplying the selling price by the quantity sold and the quantity sold, and then get the variable cost, total variable cost, by multiplying the variable cost per unit times the quantity sold. And so you add the variable cost to the fixed cost, you have gotten total costs. So in the graph, you are only plotting the fixed cost line, total cost line, and the sales line. So once you take a scale on the y-axis and the x-axis, y-axis represent the costs and revenue in thousands cedis or in millions or in whatever Ghana cedis. Then the x-axis represent the output, also in thousands or in whatever units. Then you just plot the fixed cost. We are saying that the fixed cost is fixed when output is zero or is incurred when we have not even started production. So at the activity zero, total cost is fixed cost. So to plot the fixed cost line, you pick an appropriate point on the y-axis, and that will remain constant irrespective of activity level. So it becomes parallel with the x-axis. That line, fixed cost line, is parallel with the x-axis, and it starts on an appropriate point on the y-axis depicting the fixed cost. Then you now plot is this one. Hello? Yes, please. Good morning. Please, I'm teaching. I'm teaching. Yes, so I was saying that once you plot the fixed cost, the next line to plot is the total cost line. You know, you have added the fixed cost to the variable cost, you have gotten the total cost. Of course, so once you have plotted the Can you hear me? Hello?
Hello.
Yes, we can hear you.
Yes, we can hear you.
We can hear you, sir.
Okay. So what I was saying is that once you have plotted the fixed cost line, we get the total cost line by superimposing the variable cost line on the fixed cost. So because at output zero, total cost is equal to the fixed cost. So when you now start producing, then your total cost becomes fixed cost plus variable cost. So therefore, the variable cost line is superimposed on the fixed cost line. So to get the total cost line, you look at where the fixed cost line is, and then you trace it to the maximum sales, and then get 2 points. So what all that you do is that get 3 coordinates or 3 points on the line, and then you can use your ruler to get it straight. So you start with the total sales. Total sales at the x-axis and its total fixed cost. Total fixed cost, you plot one there. Then you look at any other activity, you plot another one, and then you can just get straight line to the fixed cost line, fixed cost point. You have gotten a total cost line. Then you know sales revenue is 0 when output have not started. So we only get sales revenue when you multiply the selling price by the total output. So the total sales is the total output or total activity times the selling price. So when output is 0, sales is 0. So it means that the sales line sales. The maximum sales is depleted from the total sales. Then you trace it there, get 3 points. One at the top there, at the middle, and then the 0, the origin. Then you can get your straight line. After that, the point where the total cost line intersect, that is the break-even point, because it's that point where total revenue is equal to total cost. So at break-even point, total revenue is equal to total cost, and therefore there's no profit nor loss made. So any sales below the break-even point, any sales below the break-even point, you will see that the total cost line lies above the total revenue line, and that zone, that interval that is created between the total cost line and the sales revenue line is the profit zone. Then after the break-even point, any other sales you make, you are going to make profit. So you can see that after the break-even point, the sales revenue line now lies above the total cost line, and the interval that is created between the sales line and the total cost line becomes profit. Then we're saying that at the break-even point, when you trace the point where the two lines meet to the total quantity line, you get the break-even point. When you look at the difference between that and then the maximum sales, that is margin of safety in units. Then if you go up the y-axis, the break-even sales and then the maximum sales gives you the margin of safety in value. And then the lines, you can just name the line. So it is not any difficult thing done. And once you see the break-even chart like that, the intervals between the wider the margin of safety, it tells you the viable the project, it tells you how good or how better the company can break even earlier and then make maximum additional sales to make profit. So if the difference between the break-even sales and then maximum sales is wider, it tells you that the project or the business will be a good one, right? And so we can say the margin of safety can actually be calculated in units and in value, and it can also be calculated in percentage. Margin of safety in units is the difference between the break-even point in unit and the break-even point maximum budgeted sales or maximum sales in units. Margin of safety in value is the break-even sales. The difference between break-even sales and then maximum sales in value. Then, if you want to calculate the margin of safety in percentage, it is the margin of safety that is whether in unit or in value divided by the budgeted sales or the maximum sales times 100, right? So that is that. Then from there we started with the equation approach, and the equation approach. Let's project, then we can go through that one. If you have any question with the break-even units using the graphical method, you can now ask questions on that. But note that in examination, you can be given a question to plot the break-even chart, and all that you do is use a graph sheet and be able to plot it well, right? Please, can you see the screen?
Yes, sir.
Yeah, it's downloading, so let's wait for it. What is that? Yeah, so we're talking about the break-even analysis using the equation approach. And then we said that the cost volume profit relationship in equation form, the cost volume profit relationship can be explained also in the form of equation based on the contribution format income statement as follows. So we know that we have done marginal costing, and we know that when we are using the contribution approach or the marginal costing approach in preparing income statement is prepared by deducting variable costs from the sales revenue. Here we're talking of total variable costs from the sales revenue to get contribution, and then we less fixed costs from the contribution to get to get profit. You understand that format already. So in marginal costing, we determine the contribution or operational profit by deducting variable costs from the sales to get contribution, and then we less fixed costs to get profit. So the same approach here is what we are using. So in this calculation equation format, we say profit is equals to sales less variable costs less fixed costs. Now, sales less variable costs will give you contribution, and then you less fixed costs. So we use the term profit to stand for the operating income in the equation. Of course, the profit is the operating income. When a company has only a single product, we can further redefine the equation as follows. So the equation we have written here can be written this way, that we know that sales will be equal to selling price times quantity, and then the variable cost will be total variable cost will be variable cost per unit times the quantity sold. Fixed cost, that one will be given in total. So therefore, the equation will be profit equals to selling price times the quantity minus variable cost times the quantity minus fixed cost, where the selling price and the quantity will give us the sales revenue, and the variable cost times the quantity will give us the variable cost, total variable cost, right? So, but at break-even point, we are saying that sales is equal to zero, because at the break-even point, no profit or no loss is made, and that the firm total cost is equal to 8 total revenue. Therefore, sales will be equal to the variable cost plus fixed cost, because variable cost plus fixed cost is equal to total cost. And sales, if you are saying that we are at break-even, then means that sales will be equal to the total cost, which is equal to fixed cost plus variable cost. Hope you understand that clearly. But this sales is equal to price times quantity, which therefore will be equal to the variable cost, which is a variable cost per unit times the quantity plus fixed cost. And therefore, when you group like terms, just group the like terms. The question has not brought the last one. So if you group the like terms, it means we are factoring the total the quantity out. If we total the quantity out, means that the equation will be equal to Q equal to Q into bracket P minus V. That is total cost quantity into bracket times the difference between the fixed cost, the price and the variable cost will be equal to the fixed cost, right? So once you now say Q is equals to Q into bracket P minus V is equals to fixed cost, Then we want to get the kill, because the kill is the quantity that will sell to break even. So we want to get the kill. So the kill therefore will be equal to fixed cost divided by P minus V, where P minus V is the contribution per unit. Is a contribution per unit, right? So this is what brings us to the equation for the break-even point. And this simple break-even point formula, which is equal to fixed cost over contribution per unit, is what is going to help you to do the analysis. This formula can be varied, right? We can just look at the break-even point in units and in value. So break-even point in units is simply the quantity we want to produce. That is the quantity to produce at the break-even point. So that break-even point in units is equal to fixed cost over contribution per unit, where contribution per unit is equal to selling price minus variable cost per unit. Then you can say we can also calculate break-even point in value. So the break-even point quantity can be multiplied by the selling price to get that. You can also get the break-even sales in value by multiplying the formula, that is fixed cost over contribution per unit times the selling price. Or you can actually divide the fixed cost by contribution margin ratio, right? So we are saying that the equation approach to computing the break-even points, the break-even point is the level of activity where total costs equal total revenue. We all know that. That's at this point, at this level of activity, no profit nor loss is made. Right? So that the break-even point, no profit nor loss is made. Take note of that and put that at the back of your mind so that you can always define break-even point. As we noted either in session 4, the break-even point can be in sales units and in value. So break-even point can be calculated in sales unit or in value. So from the calculations that we did from the equation, we're saying that break-even point in unit is equal to fixed cost over contribution, where the is selling price. And so if you now want to get the break-even point in sales value, we just have to multiply the equation by selling price. So it's fixed cost over contribution per unit times selling price, right? So you can just put the selling price. This selling price should be somewhere here. It should. So it's because we divide the fixed cost by the contribution per unit, and then what we get is multiplied by selling price, right? Or you can also determine the break-even dividing fixed cost divided by contribution margin ratio. Contribution margin ratio has been explained down. It is the ratio of the contribution per unit over sales, contribution per unit over selling price, or total contribution over total sales. So if you look at how much percentage is contribution to sales, that is contribution margin ratio. You can divide the fixed cost by contribution margin ratio. That will also give you the total sales revenue. You can also find the break-even point in units. You can also find the break-even point in sales value by simply multiplying the break-even quantity in break-even quantity by the selling price, because the first equation here will give you as the break-even quantity. So if you multiply that by the selling price, you have also gotten it, right? So that is it. Now we said the contribution margin ratio here is calculated by dividing the contribution by sales. Also contribution. So the ratio itself speaks for itself. The name is contribution sales or contribution sales ratio, contribution over sales ratio, or we make it normally contribution slash sales ratio. So it means that contribution over sales, right? So contribution over sales ratio is contribution over sales, and it can be calculated by total using the total or in units. So now contribution to sales ratio is also called contribution margin ratio. So another name for contribution sales ratio is called contribution margin ratio, right? Because margin is sales. When we say margin, most of the times in business, you say sales is margin. So when you say contribution margin, we are talking of contribution sales ratio. Now, let us illustrate the equation Let us illustrate the computation of the break-even point using the equation above. So let's look at a simple question. Nkwa Enterprise makes a single product with a sales price of 100 cedis and marginal cost of 60 cedis. Fixed costs are 60,000 per unit. So this is a very simple question. All that you need to do, because we have already calculated the break-even point, formula for break-even points in units. And we say the formula for break-even point in units from our calculation or equation is fixed cost over contribution per unit, where contribution per unit is equal to selling price minus variable cost. So you can calculate your contribution per unit. Once you calculate your contribution per unit, then you can quote the formula or code the formula first. Now put in the values. The formula for break-even point in unit is fixed cost over contribution per unit, as you see, where contribution per unit is selling price minus variable cost. So you calculate the contributions as the selling price is 100, then the contribution, the marginal cost or the variable cost is 60. So 60 minus 100 minus 60 gives you 40. So contribution is equal to 40. Do that one side, and then now bring your break-even formula, fixed cost of the contribution per unit, and therefore the question becomes fixed cost, which is 60,000 divided by 40 cedis, and that gives you 1,500. You can also calculate yourself and see. Then we're saying that you can get a break-even sales value by just multiplying the fixed cost of the contribution per unit times 100. So fixed cost is 60,000. Contribution per unit is 40 cedis times selling price, which is 100. That gives you 150,000 Ghana cedis. Now, we also said that you can get the contribution break-even sales in value by multiplying the break-even quantity by the selling price. Now, break-even quantity is equal to 1,500. When you multiply by the 100 Ghana cedis per unit, you still get the 150,000. We also said that the contribution break-even sales in value can also be gotten by dividing the fixed cost by the contribution sales ratio, or contribution margin ratio. So first, calculate the contribution margin ratio. Contribution margin ratio here is the contribution per unit over selling price, right? Because we have it in units. So if you like, don't even multiply by 100, just leave it in decimal. So contribution over selling price will give you the ratio, because the ratio will be in decimal, right? Therefore, before we continue, let's use the formula to find the break-even points in units and sales value and contribution sales ratio on the question under session 4. We haven't gotten to session 4 yet. Now, apart from the three, so we will look at that. Apart from the three formulas. Hello?
Yeah, sir.
Yes.
Yeah. Please, the fixed cost in the question given to us is 69,000, but the working
No.
are using 60,000.
Are you not seeing the form? What do you call it? The what do you call it? You can't see the screen.
The screen.
Yeah, I can see the screen, but the question.
Okay, so
the
fixed cost here.
question.
Listen, this fixed cost is 60,000. The question says that selling price is 100, variable cost is 60, and fixed cost is 60,000. Where from the 69,000 you are talking about?
Oh, okay.
The book is 69.
Yeah, there is a
Mistake in the book.
They made a mistake in the book. We go by the book. So, sir, please, kindly.
No, there is a mistake in the book. The book is 69,000.
Collins, there is a mistake in the book. When you look at the solution, they use 60,000, but in the question they made it 69,000. So you can correct it in the book.
Okay, but even what is very important is you understanding the information, whether it is 69 or 60. The formulas is what you need to understand and then work with, because in examination you are not going to be given the same 60 or the 69, right? So what is very important is your understanding of the formulas and how you are putting in the formulas to get. So let us solve the question we are seeing on the screen now. What is in the book might be a mistake, but even if it's a mistake, they will get the values, unless of course the figures, the answers they are giving is wrong. But if the answers they are giving is in line with the 69,000 face cost, then that will also not be wrong per se. Do you understand that?
Yeah, the answers are following the 60,000, not the 69,000.
Okay, so if the answers are following the 60,000, then definitely you have to correct that one to 60 instead of 69.
But with the C, the contribution to sales ratio, that one to instead of they use 40, they use 60,000 divided by that's
so what was the contribution in the book?
The contributing to sales ratio is supposed to be 40 over 100 times 100, but they miscalculated.
Made a mistake.
Yes, so please
that one
take note of that. So that is why you need to come to class so that you can understand these things. Then you don't just go and read mistakes in the book, right? So just correct them. All right.
When we're done, you can drop it for us in the group, so you can.
Yeah, because I don't have the hard copy. Yes, that's why I don't have the. Maybe I have to go for one. What I have is a soft copy now, and some of you have the soft copy. Is that not it?
Yes, we are all
Yes.
the soft copy.
Sir, most of us, even Burger Center, none of us is having hard copy.
Okay, so then put the hard copy somewhere and let us use the soft copy.
In the soft copy that I'm using, but the contribution to sales ratio is the mistake is there. That is the soft copy.
No problem. We'll see it. We haven't got there. So we'll get there is mistake. I'll let you know. Okay. So, but this one is not a mistake. This is 40. Contribution is 40 over 100 cedis. That is selling price times 100. And I'm saying that you can leave it in decimal instead of multiplying by 100. You can leave it in decimal.
The software is different from ours. So the soft copy is different from ours.
My soft copy is different from yours.
Yes, yours is with the
Yes,
correct
sir, it's different.
and the correct question.
Okay, I think I corrected them. I think I corrected them when I was using it to teach the previous one. All right.
Okay.
I corrected them with the students. I corrected them. So it was like that, but I corrected them when I was teaching the last batch. So you also have to correct it.
So please, sir, can we have your soft copy sent to us in the page?
Oh, but you can correct yourself. You can edit it. You can edit it.
It's
a PDF.
It's a PDF form.
So if you
your soft copy is very simple.
Okay, all right. Then I will send them to you.
Yes, please.
It is about 60 something AO sessions. So 36 sessions. One session. Okay. So it's plenty. If you can download them, I will send it.
Yes, sir.
Okay. All right. So we are saying that before you continue, use the formula so we don't have that question. Apart from the 3 formulas we have discussed, there are other formulas that can be used to compute the break-even point under different situations. So once we have gotten the break-even point, we can actually use it to determine so many other things. One of the other calculations you can do is to get a level of sales to achieve a target profit. Sometimes organizations want to make a given target profit. So we know that at break-even point, we are not making any profit. So the quantity to be sold to break-even will be known. But if you want to make profit, we can also use the same analysis to determine how much quantity do we have to sell in order to make that target profit, right? So level of sales to achieve a target profit in units, the formula becomes the fixed cost plus target profit over contribution per unit. Remember that at break-even point, there's no profit nor loss made. But if we want to make profit, then the contribution should cover the fixed cost and profit. When we are calculating the operating profit using the marginal costing approach, we know that when variable costs are taken from the sales revenue, the contribution obtained is made up of fixed costs and variable costs. Fixed costs and profit. The contribution should cover the fixed cost and profit. Therefore, if there's no profit, the contribution will be equal to the fixed cost. But when there's profit, then the contribution should be equal to fixed cost and profit. This is from the selling price, and we get contribution per unit. The total quantity that will be sold, should be give us the cover the fixed costs and the profit. So if a company wants to make a given target profit, then the formula will be simply the fixed costs plus by contribution per unit. That should give us the target profit. So a quantity to be sold in order to make a given target profit, the cost plus the target profit divided by contribution per unit. And also, so the level of sales to achieve a target profit. So we can also determine the sales revenue to be able to achieve a given target profit. In that case, it's the same formula, just like we did for the break-even point, where we multiply the fixed cost over contribution per unit times selling price. Here too, you just multiply the fixed cost by the target profit divided by the contribution per unit times selling price, right? Or you can also get it by dividing the fixed cost by the target profit by the contribution sales ratio, just like we did for the break-even sales in value. There are three ways you can calculate. You can multiply the target profit in units or quantity to be sold in order to make a given target profit times the selling price. Or you can also obtain that by dividing the fixed cost by the target profit by the contribution margin ratio. Here, the contribution margin ratio should be in decimal, right? Not in percentage. We can also look at the level of sales to achieve a given target profit after tax. Company pay tax on their profit. And so if the firm wants to make a given target profit after paying the tax, then the formula, the target profit must be grossed. In that case, the target profit must be grossed to include the tax element, so that when we add that to the fixed cost and we divide by the contributing margin ratio, the quantity that we'll get when we multiply by the contribution, the price will be able to cover the fixed costs and then make that given target profit after tax. So here we are saying it could be, the formula can be fixed cost by the target profit all over contribution times one over 1 minus the tax rate. And this one, if you approach this one, to be difficult for you. So the second formula is the best, right? Because we're only trying to gross the target profit. So you can just make it fixed cost plus the target profit all over. And so the 1 minus the tax is only affecting the fixed variable cost. If you use this one, you might think that the 1 divided by 1 minus the tax rate is affecting the whole of the equation here. No, it is just affecting this fixed cost, total cost, total profit. It's the total profit that you are trying to gross. So you can add it to the total fixed cost and divide it by contribution per unit. So when you come down here, forget about the first formula here. Always use the second formula here, where fixed cost plus the target profit divided by 1 minus the tax rate will be divided by the contribution per unit. That will be the quantity that you sell to be able to achieve a given target profit after tax. Now, if you want to determine that same target profit after tax in sales value, you just multiply the whole of this formula by selling price, or the quantity you get after getting here. That is a quantity to achieve a given target profit multiplied by the selling price. Or you can divide the whole of the fixed cost plus the target profit all over 1 minus tax by the contribution margin ratio. So always for the sales revenue aspect, whether it is break-even a point in unit or in value, or target profit in value, or target profit after tax in value, there are three ways of getting it. You multiply the equation or the formula by the selling price, or multiply the quantity you have gotten for calculating the unit by the selling price, or you divide the total cost by the contribution margin ratio, right? So now let's go ahead with the question that we are doing. The selling price is 100. The variable cost is 60, and then the fixed cost is 60,000. Take note of that information. We are continuing. So we have already done for ABC. We have already done for A, B, and C. Now let's go to D. Let's go to D. So we are saying that what number of units will need to be sold to achieve a profit of 20,000 per annum? And we are saying that the formula for calculating that is the fixed cost plus the target profit all over contribution per unit, right? And then the next one here, the DE here is what level of sales will achieve a profit of 20,000. So the same formula, fixed cost plus the target profit divided by contribution per unit times selling price. That is the formula for this one. And then the F says if the tax rate is 40%, how many units will be needed to be sold to make it a profit after tax of 20,000? So in that case, we are looking at a profit after tax. So that the formula becomes fixed cost plus the target profit. But here the target profit is grossed. So it's a fixed cost plus target profit all over 1 minus the tax rate, right? All over contribution per unit. And so you can also calculate that one in units in value, right? So now let's look at what the solution will be. That the E says that because of increasing costs, the marginal cost is expected to rise to 63 per unit, and the fixed cost to 70 per unit. If the selling price cannot be increased, what will be the number of units required to maintain a profit of 20,000 per annum? This is called sensitivity analysis. Break-even analysis can be used to actually determine changes in the fixed cost and then the variable selling price and even variable cost. We said that one of the uses of break-even points or break-even analysis is to actually determine to perform sensitivity analysis, where we can ask what if questions, even though we have actually make an assumption that in making the break-even analysis, selling price should remain constant, variable cost per unit should remain constant, total variable cost should vary, fixed cost total should remain constant. However, the analysis can be used to actually ask what if questions, and that's what we call sensitivity analysis. So therefore, this question G, sub-question G, is just asking that even though we have made that assumption, what if in real case fixed cost change or variable cost per unit change? What will be the effect on the break-even point and even the target profit? So those are analysis that can be done. So if you look at the based on our illustrations, let us now add question D to G to illustrate the equation 4 and 6, right? So we now look at D. It's asking for the level of sales to achieve a target profit. And this is given by fixed cost plus target profit over contribution per unit. We know that the contribution per unit is already 40. We have calculated that one earlier. So our fixed cost is 60. Now the target profit is 20. So fixed cost by the target profit divided by the contribution per unit. And that the quantity that if we sell, we'll be able to, make a given target profit of 20,000 is 2,000 units. Remember that the break-even point in unit was 1,500. So if you're able to sell 2,000, then we'll be able to make a given target profit of 20,000, right? Then we can also determine that one in sales value or the level of sales to achieve a target profit. here we are saying that the same thing here multiplied by selling price. Multiply by, so look at where the selling price has been. It is wrong. It is not supposed to be here, right? Take note of it. It's supposed not to be here. It's supposed to be times. I don't know how it can be done, but I will have to work on it. I don't know whether it's the same in your book. Is it the same in your book?
Yes, it's the same.
So it is 60 plus 20 divided by 40 before you bring times the 100. So you don't multiply the 100 by the 40 before you divide it. It will be wrong. You won't get it.
No,
so
they are using the contribution to sales ratio. It's correct.
They are using the contribution. Oh, okay. So it's over.
Yes.
All right.
40 divided by 100.
Okay. I'm sorry. I was looking at the contribution per unit. So it's contribution to sales ratio here. So if you are using contribution to sales ratio, remember that you have calculated the contribution to sales ratio, and that is what 0.4. So yes, if you divide 80 by 0.4, you get the 200. But this is one way of getting it. You can also multiply you can also make it fixed cost plus the target profit all over contribution per unit, which is the 40 times the selling price, right? Times the selling price. Or yes, you can even multiply the quantity you have gotten here in the first place, this 2,000 by the selling price. If you multiply this 2,000 by the selling price, that is also one way of getting it. So 3 ways of getting the sales in value. Okay. So you can also multiply the answer in D by the selling price. The answer in D, that is the quantity, by the selling price per unit. That is also going to give you the same amount. Right. Now let's look at the level of sales to achieve a target profit after tax. After tax. So here we are saying that the formula is supposed to be fixed cost plus the target profits all over fixed cost plus the target profit divided by 1 minus the tax. So take note of where the 1 minus the tax is affected. 1 minus the tax is only dividing the total target profit just to get the gross profit, right? Before you divide by contribution per unit. So here the formula will be 60,000. That's fixed cost plus 2,000, 20,000 divided by 1 minus 4. And so it is going to be 20,000 divided by 0.6. 20,000 divided by 0.6. And that gives you 33,333. Okay, so you have the total cost now to become 93,333 divided by 40. That gives you that if you sell, you'll be able to make a given target profit after tax of 20,000. See, so because of the tax element, we need to sell tax. We sell 20,000 to make the 20. We sell 2,000 to make the 20,000 profit. But now that we are talking of profit after tax, the unit $333, right? So to get it in sales value, to get the same profit after tax in sales value, you can multiply the quantity fixed cost. You can divide the fixed cost by the target profit here by the contribution margin ratio. Contribution margin ratio was 0.4. So 0.4 divided by, multiply this same thing by selling price here to give you the same thing. Now let's look at break-even point in units. Break-even point in units. That is fixed cost per target profit over contribution per unit, right? So we are looking at the G. The G is trying to find out what will be that if the selling price cannot be that because of the increased cost, the marginal cost is expected to rise to 63. You remember that marginal cost is same as the variable cost. is expected to rise to 63 per unit and fixed cost to 70,000. If the selling price cannot be changed or cannot be increased, what will be the number of units required to maintain a profit of 20,000? This is not what has been this one. They have rather solved for the break-even points. The new change the break. Okay, sorry. So that is it. So we are saying that the fixed cost price target profit divided by contribution per unit. And now we need to now put in the formulas, put in the changes in the variables that have been given. Now, selling price is 100. It's unchanged. By the contribution, variable cost is now 63. So what will be our contribution? Variable cost is now 63. So our contribution will be selling price, which is 100 minus 63. And that will give us a new contribution of 37. Now, our new fixed cost is 80. And then the target profit of 20 is added. So we are going to have this 70 fixed cost plus the target profit divided by the new contribution per unit. And that gives us a target unit to be sold. That is 2,432 units. So take note of this. Now let us solve the self-assessment question here. Let's use the information to solve the self-assessment question here. Okay. So please take your jotters. Take your jotters and let's try to solve these questions. Okay. Oh, where's my pens? Okay. Please, I'm looking for my sheet.
Some maybe ready be I. Some maybe ready be no. So
use your hands. Okay. So we are solving self-assessment question. 2.3. The question says that Adam Limited manufactures and sells product X. The cost data for the company's next financial year are as follows. You have the planned output is 20,000 units. Selling price per unit is 80 cedis. Variable cost per unit is 45, and the fixed cost is 240 Ghana cedis. You are required to calculate the number of units to break even. Profit of 60,000. So that is that. So first one is A. Adum Limited, Adum Limited. Okay. So first question is number of units to break even. So break even point in units. We said that's given by fixed cost over contribution per unit, where contribution is equal to fixed cost, contribution equals to fixed cost.
Selling price minus.
Yeah, selling price minus variable cost. All right. Okay, so now fixed cost is 240,000 divided by
25.
the contribution. Contribution is 80 minus
45.
Giving us what?
35.
Giving us 35.
Yeah.
Okay, so therefore, our is fixed cost 240 divided by 35 Ghana cedis. Okay, so
6,857.14 units.
800 and what?
57.
57.14. Yes,
let's leave the 0.14. So
okay,
867 units.
Yes.
Right. All right. Then the second one says break even in sales value. Break even in sales value. That will be given by, you can just use the fixed cost over contribution per unit times selling price, right? So we have fixed cost of 240,000 divided by 35 times 80 times 80 Ghana cedis. All right. So you have the unit to be 8. So when in this case, when you divide, just multiply it by, don't shorten it, just multiply it by the 80, right?
80. Yes.
So you get the answer. So you have the 857.14 times the 80, and
80.
that gives us what?
500.
500, exactly.
540 something.
5485.
548
548 571.
571.
571.
Okay, good.
Yes.
Ghana cedis. Now let us use the contribution margin ratio to also find it. Now let's calculate our contribution margin ratio. Our contribution margin ratio is equals to 35 over 80. That gives us what? What decimal?
80.
35 over 8.
It will give us 0.4375.
0.4375. Good. So now to get the break-even sales, it is fixed cost over the contribution margin ratio. So we can also say the break-even sales is equal to fixed cost over contribution margin or contribution sales ratio, right? So we have the 240,000 divided by 0.4375, and that gives us what?
Please come again.
Yes. 240,000 divided by 0.4375.
So it will give you the same answer.
It will give us the same answer. That is
548.
Good.
571.
Right. So that is it. So then we come to the B. B says that we should determine the quantity to be produced and sold to earn a profit of 90. Now target profit in units is equals to fixed cost plus the target profit all over contribution per unit. And so our fixed cost is 240,000. Our target profit is 90,000. All divided by our contribution per unit, which is 35, eh?
Yes,
35. So we get the total to be 300 what? Where's my calculator?
330.
330,000
divided by the contribution, which is 35.
35, good. And that gives us what?
9,428.
9,428 units. Add a unit to.
Okay.
Unit. All right. So that is it. I don't think it's a difficult thing to do. When it comes to examination, you can do it. Can't you do it? You can
I shall help us.
So now let's try your hands on. Try your hands on the Hansma. Hello, somebody is talking.
Is the C again, the quantity to be produced? The calculation
So the
again, I've missed it.
the formula for calculating the break-even target profit in units is fixed cost plus target profit. I have said that, you know, that when we take, you remember we have done marginal costing, and in the marginal costing to get profit, we take variable cost from the sales revenue, we get contribution. Contribution is amount that contribute to cover fixed costs and subsequently profit. So at the break-even, when we are not making profit, contribution will be equal to our fixed costs. But when we are making profit, contribution should be equal to fixed costs and profits. Have you seen? So if we are determining we are saying that we want to make a given target profit, the analysis can help us to determine the quantity that if we sell, we'll be able to make a given target profit. So all that we do is that get the total contribution and divide it per the contribution per unit. Total the profit. That will give you the total contribution, because if you intend to make profit, your contribution should be covered the cost and the profit. Therefore, then the total contribution is supposed to be equal to the fixed cost plus the profit. And if you want to determine the unit to produce to make that profit, then we need to contribution by the contribution per unit. So total contribution here will be the fixed cost plus the target profit. Then you divide by the contribution per unit to get the quantity that if you sell. Have you understood it? You still don't understand?
Yes, please.
Okay. So that is what the formula is. Cost plus target profit, right? Divide. So it becomes a simple thing to do. So it's going to be 240,000 plus the 90,000 divided by 35 contribution per unit, and that gives us 333,000 divided by 35, and that is giving us quantity that if you sell, we'll be able to make a given target profit of 90,000, and that is 9,428. All right. Any other person who don't understand? Now solve this question. Yes.
Please, my question was on the level of sales to achieve after tax profit.
After tax profit.
Yes, please. So yes, the one minus tax.
So it is so in that case, we are only grossing the profit. Like this 90,000, assuming that there's a profit target, a profit of let's say 20%. We will gross this 90,000 by the tax element. And so to do that, we are going to divide this 90,000 by 1 minus the tax. 1 minus the tax, because the profit we want to make supposed to be the 101, right? The 100% is the profit we want to make. But we have to take away the tax element so that we will be able to get the amount from which we are going to take the profit supposed to be 100%. Therefore, we are going to take one representing the total profit before you take the tax element from it. So you divide this 100 by 1 minus the tax element. That will give you the total amount that you require. When you take the tax element from it, you'll be able to make your target profit. Then you add that one to fixed cost. So it is the target profit divided by 1 minus the tax rate. You understand that? So we shall see.
The previous one we work now. That was the F. The 1 minus tax on. They let them put 1 minus 40. I don't know. So that's when I did it.
Tax rate was 40%.
Yes.
You can make it decimal. Yes. So please.
So that was
it should be decimal. It should be decimal.
Yes.
It should be decimal.
Okay.
Yes. Okay. It should be decimal. So it's 0.4, not 40%, right?
Yes. Okay, sir.
It's supposed to be 0.4. If you make it 40, it means that you have to convert the 62 to listen. Or in that case, you have to make it 100, and then when you finish, multiply by 100. It's not all necessary. So just make it a decimal, right?
Okay, sir.
Okay. Now you can do the Consumer Limited. Consumer Limited most recent data is as follows. So you have the planned output, the selling price, the variable cost per unit, and the fixed cost. calculate the number of units to be sold to break even. If selling price increase by, do we have to solve that one too?
Yes.
Yes,
Okay,
please.
so let's solve it. So when we are talking of, please, all of you work together. Take your jotters and work. You are solving it yourself. So we have A, Pansma Limited. Break even, just shorten it, break even point in units. It's given by fixed cost over contribution per unit, where contribution per unit is equal to selling price minus variable cost per unit, right? And so our contribution is equal to 15 cedis
minus 9 cedis.
15 minus 9, giving us what?
6 cedis.
6. So our contribution is 6 cedis. So now the formula, you fill in the formula, fixed cost is 70,000, all divided by 6 cedis, giving us how many units?
11,666 units.
11,666.
You run it off to get 67.
11,666.
66. Okay.
So you run it off to 8.666.
0.666. We can make it 7.
Yeah, we can make it 7.
Right. All right. Okay. Then you come to the B. He said if selling price increased by 1.5 per unit, what will be the new break-even point? So this is the sensitivity analysis that I talked about. In this case, all that we do is that just get the new information. So the new selling price is going to be what? 1.5, giving us what? 16.5. So the new selling
decrease.
Decrease.
They were saying if
sorry, decrease.
So you subtract it.
Decrease, subtract. So that will be 13.5.
13.5.
13.5. Good.
Yes, please.
Okay. Now, once you have gotten new selling price, it means that you have to get a new contribution. But the contribution you calculated, which is 6, may not hold now. So to be able to get your break-even point, you need to get a new contribution. So now the new contribution will be
4.5.
4.5
is equal to 13.5 minus
9.
Minus 9, because variable cost is not changed. If the variable cost also change, then that will also be changed. So that is 4.5. So now your new break-even point
15,000
is equal to
556.
15,000.
That is the unit.
Yes.
You have calculated the unit already. So 70,000
divided by 4.5.
4.5 Ghana cedis. That gives us 15,000.
15,555.
555.
When you run it up.
Okay. Units. I hope you are all understanding. We are all getting it. Don't fall behind. Try to understand. Please. Okay. If you fall behind, you are going to have problem. Right. So now the second, the C says that assuming the selling price increases by 12%. Have you seen now? So we can actually increase the selling price by absolute figure, or we can increase the selling price by percentage. The same way the variable cost can be increased by percentage or can be increased by a certain amount. So take note of these things when it comes to examination. So assuming the selling price increases by 12%, variable cost increase by 0.6 per unit. Have you seen? What will be the break-even quantity? So in the same way, we just get the new information, right? So our new selling price now will be
13.5.
Is it going to
12%?
12% to 12%.
So the 12% will it be calculated on the 13.5 or the 15?
No, we will make reference to the old information.
Old information, okay.
Yes. We are not going. We are basing all of them on information given us. So now the new selling price is going to be 12. The 15% is going to increase by 12%.
1.8. Okay.
So the best way you can do is that just multiply the 15 by 1.15, 12. Multiply the 15 by 1.12. That gives you what?
16.8.
16.8.
It gives us what?
16.8.
16.8. Very good.
Yes,
now,
please.
the new marginal cost or variable cost is also 9.6. 9 plus 0.6, right?
Yes.
That's going to give us 9.6.
9.6. Yes, sir.
So what will be our new break-even, our new contribution?
7.2.
It's going to be 16.8 minus 9.6. That gives what?
7.2.
7.2. Good. So now that you have gotten this one, once you have gotten the same point, fixed cost has not been changed. So once fixed cost has not been changed, you don't alter it. Now your break-even, your new break-even will be 70,000 divided by 7.2 Ghana cedis, and that gives us how much?
9,722 units.
9,722
units.
Good. Are we all following? Are we all following?
Yes.
Then look at the question 3. Very simple.
Hello,
question.
Sir.
Yes, please.
Sir.
Yes,
Sir,
please.
I didn't get the C word. They say assuming the selling price increased by 12%. So
By
the old selling price is 15. Sir.
Yeah, it's 15. Yes, 15.
Yeah. So if it increase, we add the 12% plus 15, or
yes, but I'm saying that the best you can do it, instead of going to calculate the 12% on 15 and adding, just multiply the 15 by 1.12, right? 1 is 100% plus the 12%. So you multiply 15 by 1.12. That will give you the same thing. Instead of, if you calculate 12% of 15 and you add to 15, and then you multiply 15 by 1.12, it will give you the same thing. You understand?
Yes, sir.
Yeah, that's it. And then how we got the new variable cost? It is 9 plus 0.6. And that is also gave us 9.6. So now your new contribution, you just have to put the information to calculate the new contribution, and then you can just fix in the formula and then get the answer. We are still talking about the fixed cost over contribution per unit, but the contribution per unit now will change because of the new information we have gotten. So once you put in the new information to get the new selling price and the variable cost per unit, you get your new contribution, and that can help you solve the question. Are you clear now?
Yes, please.
Okay. So now you look at that. It says that the following information, we have sales 40,000 units. You see, this information is about the marginal costing. Do you remember marginal profit statement? Sales less variable cost, you get contribution, less fixed cost, get profit. This is all that we are doing. So once we get this info, you have this information. The question says that with this information, calculate the contribution per unit. I remember I gave this question to some of my students, regular students, and some of them were able to do it. They got confused. Okay, but you have been given sales in units. Total sales made in units is given, and you have been given total sales, total variable costs, and all that. It is very simple to calculate this. So now the question says that the contribution per unit. What will be the contribution per unit? What will be the contribution per unit? How are we going to get the contribution per unit? A.
So you divide it by the number of units produced.
We'll divide what by number?
The total contribution.
Okay, so you see, total contribution is 160,000, and then the number of units produced, the number is 40.
40,000.
40,000. So now contribution here is 160 divided by what? 40,000.
40,000.
And that gives us what?
4 cedis.
4 cedis.
4 cedis.
4 cedis. Very good. 4 cedis. Have you seen? It's not difficult. The thing, if you understand them, you do it with ease. Now, the question says that what will be the variable cost per unit? Variable cost per unit is equal to total variable cost
divided by 40.
So total variable cost divided by the unit produced, right? Total variable cost is 240,000
divided by 40.
Divided by
40,000.
40,000.
And that gives us what?
6
cedis. 6 cedis.
6 cedis.
Okay, 6 cedis. Then now the question says the level of sales unit which will enable the firm to break even. What will be the break even? So break even is equal to fixed cost over contribution
per unit.
So this is equal to fixed cost is given 100,000. Is that not it?
Yes. Sir.
You have already calculated your contribution per unit. What is what?
4 cedis.
4 cedis.
And so what is the break-even point?
25,000.
45,000.
25,000 units.
25,000. Very good.
Units. Yeah.
Please, is this difficult?
No.
It is not. The question is, the D says that calculate the level of sales unit that will earn a profit of
They see again. They see.
Hello.
Yes, please, sir. They see again.
The C says that calculate the level of sales unit, which will enable the firm to break even. So that is the break-even point in unit they are requesting. And what is the formula for break-even point in units?
That fixed cost over contribution.
Yes, fixed cost over contribution per unit. From the first calculation, we have calculated the contribution per unit, and we got how much?
4 cedi.
4 cedis. And the fixed cost in the question, how much is it?
100,000.
100,000.
So if you think that the break-even is fixed cost over contribution per unit, what will be the units? Have you gotten it?
100,000 by 100,000 divided by 4.
Or 25,000 units, right?
25,000, yes, units.
Okay, you have understood it now.
Yes, please.
Right. So let's do the D. The D says that we should determine or we should calculate the sales units that will help the firm to earn a profit of 120,000. And I've told you that can you imagine? Look at this statement we have here. The statement we have here, right? This statement. Now, if we are not making profit, it means that fixed cost will be 160, so that there is no profit. But if we are making profit, then after deducting the variable cost from the contribution, total contribution should be divided by the fixed cost by the contribution paying to get the units. So therefore, to make a given target profit, we will just add the profit to the fixed cost. We'll add the profit to the fixed cost and then divide it by the unit contribution per unit. Then we have gotten the unit that we have to show to make target profit. So to make a given target profit in units, the formula is fixed cost plus the target profit all over contribution per unit, right?
Yes, sir.
So the fixed cost in the question is 100,000. If we have to make a profit of 120,000, we'll divide this one. So the profit, the fixed cost plus the target profit divided by contribution, which is 4. Contribution is 4. So therefore, we have 220, Yes, 220,000 divided by
4
Ghana cedis. And that gives us what?
55,000.
55,000. So when the company sold 40,000 units, they made a profit of 60,000. So if they want to make a profit of 120,000, they want to double the profit, they will have to sell 55,000. Is it 55,000? Yeah. You have to sell 55,000 in order to make that target profit. So those are the information, right? You can...
Sir.
Yes, please.
Sir, please, I want you to come back to the first question, which they say calculate contribution per unit. I didn't get that place.
Okay. This is the question. Can you see contribution in the statement given?
Yes, it's 160,000.
160,000. And the question is question for you to do what? The question is calculate contribution per unit.
Per unit.
How much is the sales unit?
The sales unit is 40,000.
Okay. And if total contribution is 160,000, what will be the contribution per unit? How do we get it? How will you get it?
So you divide the 40,000 by the 160,000.
Exactly. That's what we did, and we got 4. Any confusion?
Oh, okay.
Okay. So we are moving on. I hope everybody is okay.
Yes, sir. The last one, the D, the break-even target profit. The break-even target profit, the last one.
The break-even
target profit.
It's not break-even target profit. Target profit in units. Don't say break-even target profit. You confuse yourself. Break-even is different. Break-even quantity, break-even sales is different from target profit, quantity, and sales, right? Don't confuse the two. So don't say break-even target profit. So target profit in units.
Yes, that
we are
one.
saying that the formula for calculating the target profit in units before tax, because this one is before tax, we are not talking of any tax issue. It is the total contribution. So you have to determine the total contribution. So the total contribution that should cover the fixed costs. That should cover the fixed costs and the profit. Supposed to be the fixed cost plus the profit. Right?
Okay. So how much will be the
if you look at this question, if you look at this question very carefully, look at the statement here. Have you seen? We have a profit of what?
Yeah.
Profit of
100,000. All right, 60,000.
60,000 here. All right. Now, to be able to make this, assuming we don't know the profit, and then we are told that we want to get a quantity that if we sell, we'll make a given target profit of 60,000. We'll have added the 60,000 here to the 100,000 to get the total contribution here. So if you add the total profit to the fixed cost here, you get the total contribution here. Have you seen that?
Yeah.
If you add, please, I'm asking you a question. The one who asked the question.
Please, there's a noise in the background. It's not making your explanation clear. It's like people have music and other distractions in the background.
Okay, so I'm saying that the person who is asking the question, I'm saying that if we add the 60,000 profit here, for those whose microphones are on, listen on off them. Oh. So you add the 60,000 profit here to the fixed cost. You see, it gives you back to it gives you the contribution, total contribution.
Yeah.
Yes. So then, if you divide the total contribution here by the 4 per unit, 4 cities per unit, you get the 40,000. You get this 40,000. You divide the 40. You see, that's it.
Please, if you also add the 160,000 to 60,000, you are also going to get 220,000, the same amount. If you add a profit 60,000 to 160,000, that's contribution. It will give you the same value, 220,000.
Okay.
Yeah, profit 60,000 and then contribution 160,000. It will give you the same value.
You don't add the profit to contribution, no, please. You don't add the profit to because the contribution itself includes the profit.
Okay.
Contribution is made up of profit and then the fixed cost. So the fixed cost and the profit supposed to give you the contribution. The fixed cost and the profit gives you the contribution. So here, if you add the 60 to 100, it gives you the contribution 160.
Okay.
Have you seen?
Okay, sir.
Yeah, because we want to know the total quantity that if you sell, we'll be able to cover the fixed cost and make that profit as well. Because the contribution should cover the fixed cost and the profit. So total contribution is made up of the fixed cost and the profit. And so to get the target quantity to sell in order to make a given target profit, we said it is the fixed cost plus the target profit divided by the contribution per unit. For every unit you sell, you make that unit contribution. So to make the total contribution that will cover the fixed cost and the profit, you just have to add the fixed cost to the profit and divide by the contribution per unit. And so the unit that you get, if you multiply that unit by the contribution per unit, you give you the total contribution, which will cover the fixed cost and the profit. So that is the idea. So we have target profit in units equal to fixed cost plus the target profit. And so the fixed cost here is 100,000. And then the variable cost the is at 22,000, right? 22,000 divided by contribution per unit.
So you said please kindly turn off your microphone, the one in church.
Okay. So I'm sure the person have understood it. Let's move on. If not, we'll start here. We don't have time. Because by this time we are now in the second term. We should have finished with the unit 3. Now we are still in unit 2. We haven't even finished unit 2 at all.
Yes, sir, because our 1 hour is not being covered and we're not able to get the time. I don't know if we are still doing it.
Oh.
So we'll do 2 hours on Monday.
We'll do 2 hours on Monday.
Yes, sir. 7:30 to
Okay.
9:30.
Is it coming Monday?
Yes, tomorrow, God willing. And then maybe we'll continue on Wednesday.
Yeah.
Wednesday,
Well,
we have a microeconomics, applied economics.
Oh, okay.
When?
Then maybe
Wednesday.
Tuesday.
You have Wednesday macroeconomics.
Yes, please.
So if Tuesday we don't have anything, then we'll do it on Tuesday.
We can fix it. We need to meet twice so that we can cover. If not, we'll not finish. If you don't finish and you go and write your quiz without understanding the thing. Where am I now? Okay, now we are looking at profit volume chart. Another way we can do this analysis is by determining profit volume chart. You know, if you look at a traditional break-even chart we did not show clearly the profit level for the various activity levels. We're only looking at the total cost volume, total cost line and the sales line. And so the profit from each level of activity was not known. That is a major limitation with the traditional break-even chart. So now let's look at this. By the time we finish going through this session, you should be able to draw the profit volume chart from a given data and also explain the concept of profit volume graph and explain the limitation of cost volume profit analysis. Now, we explained under session 2 that the break-even analysis is also called cost volume profit analysis. The reason is that it is an analysis of how profit changes as costs change in response to the changes in the production or sales volume. The analysis can also be shown by using profit volume chart or profit volume graph, right? So we are saying that the break-even analysis is also referred to as cost volume profit analysis. And all that is doing that, it is a study of the interrelationship between sales volume, between costs, sales and volume. That is trying to look at what happens to our profit. What happens to profit if cost change or selling price change. That's what we are doing. But the profit volume chart exhibits the relationship between profit and sales volume. The traditional break-even charts that we did suffer from one limitation. And the limitation from the break-even chart we just did is that profit cannot be read directly from the chart. It can only be determined by deducting the total cost reading from the total revenue reading. And the profit volume chart overcomes this by plotting the profit directly against the activity. So if you look at the break-even chart we did, where we constructed, where we look at the fixed cost line, total cost line, and sales volume, right? We cannot actually depict the profit at various level of activity on the charts. If we want to do that, we also have to look at the costs incurred at various level of activity, and then sales at various level of activity, and then divide to get a profit. But we don't see it on the charts. That is the one limitation for the traditional break-even chart. Now, if you really want to know what happens to the profit when cost line and sales line change, then the profit volume chart help us to do that. So the budgeted output for a factory, so let's illustrate that the chart using this information. The budgeted output for a factory is 120,000. So that is the output. It's 120,000 units. The fixed costs are 4 million. The fixed costs are 4 million, and the variable cost per unit is 50, right? The selling price per unit is 100. Now, the net profit to be earned at a particular level of sale is determined by the contribution per unit, right? The net profit to be earned at a particular level of activity is determined by the contribution per unit. So the fixed costs and that is contribution per unit and the fixed cost, and of course, the actual sales level chosen. These three factors are more clearly shown in the form of profit volume charts illustrated in 4.1 above. So we are saying that to be able to plot this, you know that profit is equal to sales minus variable cost, which will give you the contribution, and then contribution minus fixed cost, giving you the profit. So you can look at the various level of activity as you plot them, and look at the profit, the total sales at the level, and then get the total cost and get the profit at each point, and then plot it on the graph. Sorry. So let's see what we have on the graph here. So if you look at this question, let us solve it. Let's get the figures. we are saying that unit sold was 120,000, right? And then sales. Unit sold was 120,000. Selling price was 100 Ghana cedis. And then variable cost is 50. Fixed cost is 40,000. 40 million, 4 million, sorry. 4 million. So if you are plotting, let's assume that we are plotting this one in thousands. So we can say 20 units to 20 centimeters, right?
Yes, sir.
20 units, 20 centimeters. Or 20,000 units. 20,000 units is 2 centimeters on a graph. So when we plot the graph, just plot the graph. Get your X and Y axis, plot it. All of it, plot it. But this time, because it's a profit volume chart, it uses for the Y axis, it uses both the negative and positive aspect, because at output 0, fixed costs have been incurred. And so if no sales have been made, our total loss is the fixed cost. So you have to plot it this way. So we are using the negative and positive on the Y axis. And for the X, we use the positive aspect. So you scale on the X axis the unit that you are selling, right? And the total distance is 120. So if you make it 120 here divided by 20, we get 6. Is that not it? 6. So we can plot it on the 6 using 2 centimeters is to 2 units. So 20, 40, 60, 80, 100, and then 120. So you say sales or output. Outputs in thousands. In thousands. In thousands means that you have suspended. So the 20 is 20,000. 40 is 40,000. 60 is 60,000, like that, up to 120,000. Right? And then you now look at the maximum sales. No, you are now plotting the profit. So you now just look at the profit from each of the activities, right? So when output is 20, 40, 60, 20,000, 40,000, 60,000, 60,000, 80,000, 100,000, and then 120,000. What is the sales revenue? Sales revenue will be multiplied by 100. Sales revenue is 100. So it means that if you have 20,000 multiplied by 100 Ghana cedis, that gives you how much? 20,000 multiplied by 100 gives you how much?
You said 20,000 or 120,000?
No, one. We are trying to get the revenue at the various level of activity. That is 20,000, 40,000, up to that. So revenue. Then you match with the cost and get a profit. Then you can plot the profit.
Okay. So say please 2 million.
2 million. Okay. So sales is 2 million. When is 20,000? Okay. Okay. When is 40, it will be how much?
4 million.
4 million. Okay. Then it's 60 million, eh?
60 million.
No, 6 million.
6 million.
80 million.
8 million.
8 million, sorry, 8. And then 100.
10 million.
10 million. Okay. And then we saw top of that.
million.
Then 12 million. Good. All right. Write revenue on that. Now come to cost. Total cost. Total cost. Or you can even say contribution. You can just say contribution, fixed cost, and total, but you just make it total cost. Is 4 million. And then the unit variable cost is 50. So to get it to 20,000, what will be the total cost? That will be 50 times 20,000.
1 million.
That's 1 million.
Is what?
1 million.
I'm not getting you.
1 million.
So 1 million.
1 million.
Yes. Sir.
Okay. Okay. Now our fixed cost is 4 million. So it means that total cost is how much? Total cost is our fixed cost is 4 million. So variable cost is 1 million. Fixed cost is
So
4
that's
million.
5 million.
That is 5 million.
Yes, sir.
Okay. Now when our activity level is 40,000, what will be the fixed cost?
Variable cost of it.
That what will be the variable cost? Sorry.
2
When activity
million.
level is how much? 2 million.
2 million.
So 2 million plus the 4 million, that's going to give us 6 million, right?
Yes, sir.
Mm-hmm. Then we come to 60. That will be 3 million.
Yes,
3 million
sir.
plus 4 million gives us 7
100.
million. 7 million.
So you said 6 million plus 4 million.
No, since we are talking of 60,000 times 50, it gives us 3 million.
Yes. Okay. Plus
Yes. So plus our fixed cost,
of
that will be 7
400.
million.
Yes, sir.
Okay. Then we come to 80. At 80, our fixed cost will be, our variable cost will be, I think, 4 million.
4 million.
That is 50 times 80,000. Plus the fixed cost, which was 40. That is going to give us 8 million. Okay. Yes. Then we have the 100,000. 100,000. The fixed cost is what?
5 million.
The variable cost is what? 5 million.
5 million.
5 million plus our
4 million, 9 million.
That would be 9
9
million.
million.
Okay. 9 million. Good. And then the last one, we have 120,000 times. So that is 6 million plus our 4 million. That gives us what? 10 million. Okay. So now let's determine the profit. Let's determine the profit. Profit on at the various activity level. When output was 20,000, our total profit, our total revenue was 2 million, and our total cost was 5 million. So we have a loss of what? Profit loss of 3 million. Have you seen that?
Yes, sir.
There will be a loss of 3 million, total loss of 3 million. Then when the output level is 40,000, our revenue was 4 million, and our total cost was 6 million. So we have 2 million loss. Then when activity was 60,000, our total cost was, total revenue was 60,000. Sorry, our total revenue was 6 million, and our total cost is 7 million. So we have the loss of 1,000.
1 million.
1 million. Sorry, 1 million. And then because I've shortened the figures, I'm writing, that's why it's like that. Then when output was 80. Our total revenue was 8 million. Our total cost is also 8 million. So there we break even. So it means the firm will break even at what? Output 80,000. Then when it's 100,000 units, our revenue was 10,000. Total cost was 9,000. Our revenue was 10 million. Our total cost was 9 million. So we have 1,000 profits, 1 million profits. And the same way, when we come to up at 120,000, our total revenue was 12 million and our total cost was 10 million. So we have 2 million profits. So you are now just plotting this profit on the axis. So on the negative part of the cost volume profit chart, you can just start at a point, let's say a loss of say 4 million, a loss of say 4 million, and then also plot it. You just plotting the profit on the y-axis. So the y-axis is profit and loss chart. You are just plotting the profit and loss. So you are looking at output 0. Our total loss was the fixed cost. So that's 4 million, right? You put the 4 million there. Then when activity, so you can then give 2 centimeters, then you come to 3 million, then 2 centimeters, you come to 2 million, then 2 centimeters, you come to 2 million. And then now at output 0. Now on the at output 120, we have 100, we have 1 million. And then the maximum sales, we have 2 million. 2 million. So you just have to just get a coordinate, right? At output 0, you have a point. Fixed cost, total loss is 40,000, 4 million. Put a point there. When output is, let's say, 80, you break even. There's no loss, there's no profit. So you break even. Put a point there. Then maximum sales. The maximum profit is what? 2 million. You put a point there. So you just look at the maximum sales, the 3 points you have, this, then you connect them. That's all. You connect the 3 points. You have gotten the this one that they have done is a bit of a problem. It's not difficult. All that you do is that get the revenues at the various level of activity you have outlined in the total cost, get the profit, and then plot the profit line, profit on the y-axis, and then plot the output on the x-axis in the at that origin 0, and then you can just locate the total maximum loss, make a point there at the break-even point, make a point there, and then at maximum profit, that is the total sales, put a point there, and then connect with your ruler. You are done, right? So the point where the profit line, this is the profit line, or the contribution line. You can say a contribution line or profit line. Where it cuts the break-even, when it cuts the x-axis is the break-even point. And so you can see that in if you plot it using the 20 up to 120, you get it clearly than what they have done here. This one, they didn't plot it nice because the output was not 2,000. So there's no need to do that, right? So that is how it is done. Now, the profit volume chart is a simpler presentation of the facts illustrated in the profit break-even chart. It is prepared by first plotting the fixed cost below the break-even line at nil sales. So it means that the loss is plotted at the y-axis, the last end, because at break-even, at the origin 0, profit is 0, right? At the origin 0, profit is 0, and therefore total horizontal and vertical axis. The negative range of the vertical axis should be equal to the fixed cost, which is the total loss, and the positive range should be equal to the profits. That is the profit made. That is total revenue less total cost. From the example, fixed cost is 4 million and the profit is 2 million. You have done already that already. That is the revenue minus the total cost. Then the horizontal axis represented the sales. Then the break-even point is determined by joining the profit line to the fixed cost line. Intersect the fixed cost line intersect. That the sales line in the break-even point. Figure 2.4 illustrate the profit volume chart. That is what we have done already. So look at what it did. It just made it maybe in 10,000. So that now that he has used 245, 246, it means that the units will be in 10,000s, right? Because this means 20,000, 40,000, 60,000, like that. And then this one is no, you should have just get the total cost. So you see, what I have done is the right thing. Is the right thing. If I got graph, I will plot it for you to see, and I'm gonna put on your platform. So that is how it is. Any question with the profit volume chart? So the self-assessment question here says that you are required to draw a profit volume chart and to indicate the break-even point, the total, the costs and the profits. So here you have to, the information, is saying that the following was obtained from Adepa Limited. Planned output is 4,000 units. Selling price per unit is 250. Direct material per unit is 100. Direct labor per hour is 50 cedis. And then variable overhead is 25. Fixed cost is 120. So here, you see what I told you. To get the variable direct material, direct labor, and variable production overheads, what your knowledge in marginal, and once this information is given you, in trying to plot the profit volume chart, get the sales at the various level of activity after you have scaled this 40,000, 4,000. You can actually scale it in by 8. If you divide 4,000 by 8, even 8 is too much. Okay, but to get, let's say, you are going to get 500, 2 centimeters is to 500. Is to 500. You can just plot it on a graph. It will go there nicely. 8 points. Then you now look at sales at 500 and the cost at 500. Sales at 1,000, cost at 1,000. Sales at 1,005, revenue at 1,005, cost at 1,005, and then you get the profit. When you finish, you just plot it on the chart. I said the vertical axis will be made up of is actually schedule costs and profit or loss, and then you in the middle where the origin is 0, you get the output line, okay, or the fixed cost line. Somebody will say fixed cost line, but it's not necessarily fixed cost line because it's the output, right? So here, the only trick here is just to get the variable cost. Variable cost now will be the 100 plus 50 plus 25, giving you 175. That's variable cost per unit. If you don't do that and you go and pick the variable cost to be only the variable overheads, you are wrong. You'll be wrong. Variable cost is not only the variable overheads. It is also include the direct material, direct labor costs. Right. So once this is giving you, you have the fixed cost, you can easily, you are required to draw a profit volume chart and indicate the break-even point, the costs, and the profit. Then question 2 says, state 3 limitations of cost volume profit. State 3 limitations of cost volume profit. Have we talked about the cost volume profit, the limitations?
No.
Okay. So limitations of cost volume profit analysis. Now, the cost volume profit analysis have some limitation. Remember that we have made some assumption. Assumption we made is that cost should be segregated or should be separated into fixed and variable elements. Before we do the analysis, the cost should be separated into fixed and variable element. That is the assumption we made. And that the fixed costs remain constant, while variable costs will vary proportionally with the levels of activity. That is another assumption we made. And we also said that to make the analysis, cost and revenue should behave in a linear fashion. We also made an assumption that the only factor affecting cost and revenue is volume. And that the analysis should be made only for a single product or a mix, and that selling price will remain constant. These are assumptions we make, but these assumptions, I said the last time, that if you look at them in real sense or in business terms, they are not something that can be held. How can you say selling price will remain constant and that the only factor affecting volume, cost, and revenue should be volume, and that method of production efficiency, and all that should remain constant? Technology should remain constant. How can we say technology should remain constant? So these are the limitations of break-even analysis, right? So we're saying that the break-even analysis or the break-even chart and profit volume analysis assume that simple straight line to be drawn on a graph to represent sales, revenue, and cost at various level of activity. Yes, because we assume that the sales and revenue will behave in a linear fashion. Therefore, it assumes that there's a straight cost line, there's a straight revenue line. That is the assumption. While the basic concept is quite valid, of course, one must recognize that there are weaknesses in presenting the information in this form, and the break-even chart needs to be qualified by the following consideration. The one is that the consideration is that chart is only true for a single product or a mix, a certain mix of products. A change in mix may significantly change the results. Now we are saying that the assumption under the break-even analysis that the analysis should be done for a single product or a constant mix. What of if there's a change in the mix of the product? The analysis suffers. Selling prices are not constant at all levels of sales. A high level of sales may only be obtained by offering substantial discounts, depending of course on the degree of competition experience. So the assumption that selling price should remain constant is always not possible, because there are so many factors that could result in the selling price being either increase or reduce. Even if inflation does not change the selling price for us, competition can force us to make a change in the selling price that we are selling. Now we can give discounts as a result of competition that we are facing. So this is not possible. It's not always possible that we will hold the selling price constant. We also said that variable cost per unit will, in practice, fluctuate according to A, the extent to which quantity discount can be obtained or larger purchase of material. B, overtime premium to be paid to employees. And C, the general operating efficiency at various levels. So the assumption that variable costs will vary proportionally with the levels of activities. If variable cost is varying proportionally with the level of activities, it means that the unit variable cost does not change. The unit variable cost will remain constant. And so total variable cost is only going up as a result of the quantities that are being increased or the output that are increased. But in reality, unit variable costs will really remain constant because of fluctuations according to maybe discount that we are going to get when you are buying material, just as we also can give discount to our customers when we are selling in terms of the selling price. We can also get a reduction in the selling price, a price we pay for the materials we buy, which is the variable cost that we pay. Sometimes the variable cost of production could also be reduced by the fact that we have premium bonus, and that is paid to employees, and therefore actually increases our output. And then general production efficiency, all of this can affect the variable cost we are incurring. And so it is not always possible that we can keep the variable cost per unit constant. Fixed costs are fixed only in respect of a given capacity. And each fixed cost has its own capacity. Factory rent will not increase until the increased volume can be obtained from the same working space. That is, by working 2 or 3 shifts, supervision, however, will probably increase, which with each additional shift found necessary. So we are saying that sometimes fixed costs only remain fixed for a given level of activity, for a given capacity. Beyond certain capacity, fixed costs will change. We call that one step fixed cost or semi-fixed cost. So when activity level increase for a certain level of activity, it can change. Example they are making here is that when it comes to rent, fine, that one can remain constant even if you increase activity, because we can actually run shifts. So workers who come in a day will go, the others will come in a night and come and work in the same building. Therefore, we can increase our capacity using the same rent. However, when capacity increase, when productivity increase, at least if the rent is not going to increase, at least then supervision will increase, because you will increase the number of supervision, because supervision is also a fixed cost, and this supervision will increase, right? So fixed costs can actually accommodate certain capacity. At giving some at certain capacity, fixed costs will also change. So it's not always true that fixed costs will remain constant, irrespective of activity level. Then also the chart is only true at certain small steps in levels of activity, and it is important to know whether an increase or decrease is being shown. When a business suffers a decline in sales, it is unlikely to reduce its production employees in direct proportion to the reduction in activity. To do so would cause grave employee problem. It is only when it appears that the business has no hope in the short or medium term of recovering the losses that it will lay off workers or employees. The same will apply to the fixed costs. They will not be changed indefinitely if they will not be incurred indefinitely if the business has considerably utilized capacity. but the decision to reduce it may be delayed until there is clearly no prospect of obtaining extra production, extra business. So all that we are saying is that sometimes the reduction in cost might not, change that in direct proportion with the output. If there's a reduction in output, the variable costs we are incurring might not necessarily change in direct proportion. Because, for example, if the company has employed workers and the workers are already working, if the sales decline, it is not that really there and then that the company was going to lay off workers. The company may not lay off, have a prospect, and they can come back. You cannot lay off the workers and later go employ them. You can have problem. So therefore, it's only when the company realizes that there's no possibility of coming back in terms of its performance that it would then force to lay off workers. So it is not always that the relationship can be a direct can be like that. Where there has been a reduction, and so the total variable cost remain the same, right? The same is said for fixed cost. When it will not always be incurring the same fixed cost all the time. It is definitely will change at a point in time. Level where there should be increasing some of the limitations of the break-even analysis. You can see that it is the assumptions that we talked about, which then becomes a limitation for the analysis. So when you are talking about break-even analysis and you cannot remember these things, just reflect on assumptions and turn them to be a negative issue. For example, if you say that fixed costs cannot remain the same all the time because of certain things, that's all. You have gotten the answer. Variable costs per unit cannot always remain constant because certain factors can influence it. That is it. Then the sale cost and revenue line cannot always be a straight line. It can be curvilinear. Those are the points you will discuss, right? I hope you understand me.
Hello. Yes, sir.
Okay. So it means that we will not be able to extend 16. And so God willing, Monday we'll complete with the unit 2, and then Wednesday we shall start unit 3, right? When are you to write your quiz? How many times are we meeting for you to write your quiz?
So, after today, we are meeting again.
Next 2 weeks.
We are not supposed to meet again after today.
Next week is revision. Next 2 weeks.
So 11th July is the quiz.
Next week we are finishing lectures.
Next week
No,
we
we are
don't have
finishing.
lectures. We have revision.
Lectures today.
Yes.
Next week we have revision.
Yes, sir.
Okay, we'll meet. So how many units are we supposed to finish for you to go and write your quiz?
Maybe unit 3.
Unit 1 to 3. Oh, okay. Then we'll be able to do it. We'll be able to finish. All right. Then, so the profit volume chart, have you understood it?
Yes, sir.
That's very good. That's very good. Take note of what I told you about the variable cost. Here, we are talking of direct material cost, direct labor cost, direct variable production overheads. That should put together to give you the variable cost. Don't just go and pick the variable production overheads, variable overheads to say that is the only variable cost. There was a time I gave this question to some students and they just picked that one as the variable cost. I don't know why. Meanwhile, I've told them what I've told you. All right. Any question for me? Let's end here. in class, 44 students in class. Majority of you are not coming. Okay. When we are marking and you are failing, we allow you to fail. We have finished with the man accounting one and have submitted already. So very soon you get your results. Course man accounting one. Okay, so there's no more questions to answer. I want to see that. Let's meet tomorrow.
Yes.
Okay.
Okay.
All right. Then all the best. Some of you did well for the accounting one. Others too, I don't know. It is possible that some of you were not in class at all. But the way we are seeing now, because some of the things that was done, marginal costing, some people just did it anyhow. And then even the break-even analysis, break-even question. I mean, best.